Welcome to the world of high-stakes energy investing in 2026, where the search for yield and tax efficiency leads many sophisticated investors to direct participation programs in oil and gas. It is not like buying shares in a massive corporation like Exxon or Chevron. Instead, it is a way for you to become a direct owner in a specific drilling project or a group of wells. You are stepping onto the oil field as a partner, which means you share in the direct revenues and, more importantly, the direct tax deductions of the operation, in an era where traditional markets can be volatile and tax brackets remain a primary concern for high net worth individuals. These programs offer a unique combination of aggressive tax shields and the potential for significant cash flow. However, the path to energy wealth is paved with both opportunity and significant danger, and today we are going to explore the mechanics of these investments so you can decide if you have the stomach for the oil patch. The primary reason investors flock to oil and gas in 2026 is the unparalleled tax treatment provided by the Internal Revenue Code. The most powerful tool in your arsenal is the deduction for intangible drilling costs, commonly known as IDCs. These are the expenses for things that have no salvage value, such as labor and fuel and chemicals and site preparation. In many cases, IDCs represent up to 8% of the total cost of a well, and federal law allows you to write off 100% of these costs in the very first year of the investment. This means if you invest $100,000 into a program, you could potentially lower your taxable income by $8,000 immediately, which is a massive advantage for anyone in the top tax bracket. Unlike most other investments, where you have to wait years to see a tax benefit, oil and gas provides a front-loaded shield that can significantly offset your other sources of income. Beyond the initial write-off, you also have the benefit of tangible drilling costs, which cover the actual equipment like casing and wellheads and pumping units. While these are not written off immediately, they are depreciated over a 7-year period, providing a steady stream of deductions as the well produces. Then we come to the legendary 15% depletion allowance, which is often called the gift that keeps on giving. The government allows you to exclude 15% of the gross income generated by the well from your federal taxes as a way to compensate you for the fact that the natural resource is being used up over time. In 2026, this essentially means that 15% of your oil and gas income is tax-free for the life of the well, providing a powerful boost to your net return on investment that few other assets can match. However, we must balance these incredible tax benefits with the reality of the risks involved, because in the oil and gas business there are no guarantees. The most obvious risk is the dry hole, which occurs when a company spends millions to drill a well only to find that there is no oil or gas in the ground. While modern seismic technology and AI-driven geophysics have improved the success rates in 2026, exploratory drilling still carries a high probability of total loss. This is why many investors prefer developmental programs where the drilling takes place in a proven field with established production. While the potential upside is lower in a developmental project, the risk of a dry hole is significantly reduced, making it a more stable choice for those who are new to the sector. Commodity price volatility is another factor that can make or break your investment. The price of crude oil and natural gas is subject to global geopolitical events and supply shifts and economic cycles that are beyond your control. In 2026, while energy demand remains high, the transition toward renewables and the fluctuations in global production can cause prices to swing wildly in a matter of days. If you enter a program when oil is $8 a barrel and it drops to $40, your projected cash flow will be cut in half, regardless of how well the wells are producing. Successful investors typically have a long-term horizon and the financial strength to weather these price swings without needing to liquidate their position at the bottom of a cycle. Liquidity, or rather the lack of it, is perhaps the most significant structural risk of it. Unlike a stock or a bond, you cannot simply sell your interest in an oil well on an exchange with the click of a button. Once your money is in the ground, it is generally there for the long haul, often between 5 and 10 years or even longer. While there is a secondary market for producing interests, it is often opaque, and you may have to accept a significant discount if you need to exit your position quickly. This makes it a poor choice for anyone who might need access to their capital for emergencies or other business ventures. You are trading liquidity for tax efficiency and high yield, and you must be comfortable with that trade-off before signing the subscription agreement. Environmental and legal liability is a growing concern in the 2026 landscape. As a direct participant in an oil and gas project, you could potentially be held responsible for environmental damage or site remediation if the operator fails to follow strict federal and state regulations. While most programs are structured as limited partnerships to protect you from personal liability, you must perform deep due diligence on the operator of the program. You want to see a clean safety record and a history of environmental compliance and a strong balance sheet. The best tax benefits in the world will not matter if the program is bogged down in years of litigation over a spill or a regulatory violation. When you are evaluating a program in 2026, you also need to look closely at the fee structure and the promote. The operator of the program is taking a significant amount of risk and the hard work of drilling, so they are entitled to a piece of the action, but you must ensure that the fees are fair. Typical programs include a management fee and a geological fee and a carried interest for the operator, where they receive a percentage of the profits without having to put up their own capital. A common structure is a 25% promote, which means the operator gets 25% of the revenue after the investors have reached a certain level of return. If the fees and the promote are too high, it can be difficult for the individual investor to see a positive return even if the wells are successful. In conclusion, direct participation programs in oil and gas remain one of the most powerful and complex investment vehicles available in 2026. They provide a unique way to turn a high tax bill into a long-term producing asset, but they require a high tolerance for risk and a deep understanding of energy economics. By focusing on the tax shields of its and depletion while carefully managing the risks of dry holes and commodity prices, you can build a diversified energy portfolio that stands the test of time. As with any high-end investment, the key to success is due diligence and working with experienced partners who have a proven track record in the field. Thank you for joining us for this deep dive into the world of energy, and we hope this guide helps you navigate the oil patch with confidence and clarity.